In this video, we talk about several other items that affect property, plant, and equipment. Because property, plant, and equipment can be such a significant line item for many companies, it's important for us to understand several other things that could affect it besides depreciation. The first thing that we address are write-downs. Just like inventory, property, plant, and equipment whose value declines needs to be written down to market value. The loss must be recognized immediately on the income statement, and the loss can be presented in cost of goods sold, SG&A, other operating or non-operating expenses, and again, just like with inventory, if it's a big write-down, as a separate line item. Now, this is distinct from depreciation, which is a systematic reduction in the value of property, plant, and equipment. A write-down is when something unusual has happened, like the machine has broken down unexpectedly, or the value of some land has declined unexpectedly. That's when we have to reduce the value, the carrying value of the property, plant, and equipment. And the concept, again, is in line with the historical cost principle and conservatism, that although we cannot write up the value of assets, we are able and are required, in fact, to write down the value of assets when we believe that the market value is lower than the carrying value. Another item that we need to be cognizant of with property, plant, and equipment are asset sales. If a company chooses to sell some of their property, plant, and equipment, the associated gross property, plant, and equipment balance, as well as the accumulated depreciation, is removed from the balance sheet. And the way that we do this, the way that we recognize asset sales from an accounting standpoint, is if you were to sell an asset for cash, then you would debit cash, that's the cash that you received, and then the property, plant, and equipment itself will go down by both the gross PP&E carrying value, net of the accumulated depreciation. So you remove both the actual historical value that you bought the equipment at, and you remove all the accumulated depreciation. And then if there's a difference, in other words, if you sold a piece of machinery for $10 million and you had the carrying value on a net PP&E basis of only $6 million, well, then you would need to recognize, in order to get the accounting to work for debits to equal credits, you'd have to recognize a gain on sale on the income statement. It's also a logical construct. If you're selling something for more than the carrying value, then you need to recognize a gain on sale. And conversely, if you sold it for less than the carrying value, you'd recognize a loss on sale. So we are going to walk through an exercise that brings this point home. When a company sells assets, if it receives more than the net book value that it recognizes on the balance sheet at the time of sale, a gain must be recorded on the income statement. Usually you're going to see this as an other type of category, another operating line item or a non-operating line item. Again, there's a variety of ways in which companies recognize and report gains on sale. Usually it's in some other type of category, or maybe even its own explicit line item. It's also possible that the company will aggregate gains on sale of assets within the relevant cost of goods sold or SG&A category, depending on the nature of the asset that's being depreciated. For example, in our lemonade stand, the lemon squeezer has a net book value of $10,000 by the end of 2014. That's comprised of the original purchase price, the gross PP&E of $15,000, less accumulated depreciation of $5,000. If on January 1st, 2015, we sell the lemon squeezer for $12,000, remember, we bought it for $15,000 and we've already depreciated $5,000 of it. If we sell it for $12,000, which is more than the current carrying value, which is gross property, plant, equipment, net of the accumulated depreciation of $5,000, if we sell it for $12,000, here's what the journal entries would look like. First, recall that at purchase date, cash went down by $15,000, and what you got immediately was this property, plant, equipment of $15,000. But then during the year, you depreciated $5,000, and so that's going to reduce property, plant, equipment, and it's going to reduce retained earnings. So we see debits during 2014 equaling credits during 2014. Now the question is, what happens on the first day of 2015 when you sell the lemon squeezer for $12,000? At that point, you've got cash coming in of $12,000. That's a debit. And the corresponding entries are twofold. One is the property, plant, and equipment being reduced by $10,000. So the key to understanding this is recognizing that the carrying value of the property, plant, and equipment is now $10,000. After you've depreciated $5,000 from $15,000, you've got $10,000 in carrying value, which is behind the scenes comprised of $15,000 gross PP&E and $5,000 accumulated. And so in order to make the debits and credits work out, you have to recognize a gain on the sale. You sold something for more than the book value that's being recognized on the balance sheet. That's retained earnings. Gains on sale are recognized on the income statement as income. It's non-cash income. You can sort of see that the fact that the income statement is going up doesn't really have a bearing. The cash account has to do with how much you received in total. The gain on sale is just a partial representation of what happened. And so we actually, when we think about what's happening from a cash flow perspective, we really ignore the gain on sale and only focus on the fact that 12,000 came in. So this gain on sale is just this sort of recognition of what portion of the sale is above the carrying value of the PP&E that was being sold. And the key takeaway is that regardless of the sale price, only the net book value is removed from the PP&E line, and any excess gain or loss is recognized on the income statement. This is what happens visually to a company's property, plant, and equipment balance during the year. We start at the beginning of the year at a certain amount, and let's say this was 100. So this is where we start. And let's say we bought $30 worth of new property, plant, and equipment, which brings us up to a total of 130. So that's where we're at now. And then we recognize depreciation during the year, let's say of 20, which would bring us down from 130 to 110. And then if we were to sell or even write off any property, plant, equipment from a PP&E standpoint, doesn't matter whether you sell or write off. Of course, from a cash standpoint, it makes a lot of difference. But whether you sell or write off assets, let's say we sold 10, the carrying value worth of $10, brings you back to or I should say, let's make this so that visually it works out. Let's say we sold 20, which would bring us down to net PP&E at the end of the year, which is below where we started at 100. So PP&E started at 100, and all these moving parts got us down to 90. And that's the way to think about PP&E, sort of all these movements. So let's go through a simple exercise. Why don't you guys take a stab at it? Hit the pause button, read through the exercise, and when you're ready, hit the unpause and we'll go through it together. All right, so a company has property, plant, and equipment of 4,000 on January 1st. So let's write that down, 4,000. It records depreciation of 800, so that's going to be a reduction during 2014. It bought one new machine for 500, that's CapEx, so that's a plus. And then it sold one machine for 200 with a net book value of 100. So this was the only trick. We have to recognize that what we're eliminating is not the sale price. This would be incorrect, but rather the book value. So if we do the math, 32 plus 500 is 37 minus 100. We should have gotten 3,600.